Business owners know there are ways to get money out of their corporation. Most of them only really know two ways: salary or dividends. And they're leaving some of the best ones on the table. Let me walk through what's actually available to you, because this is one of the areas where the difference between a good plan and no plan is measured in tens of thousands of dollars per year. You already know these exist. Salary creates RRSP room, CPP contributions, and a corporate tax deduction. Dividends come from after-tax corporate income and carry a gross-up and dividend tax credit designed to approximate what you'd pay if you'd earn it personally. Neither is always better. The right mix depends on your RSP room, your CPP situation, your spouse's income, your personal preferences, and what might be happening inside your corporation this year. This is a decision that should be revisited every single year. It should never be set and never be forgotten. When your corporation realizes a capital gain, 50% of that gain is taxable. The other 50% flows into something called the Capital Dividend Account, the CDA. That balance can be paid to you as a capital dividend, completely tax-free. It's not tax-deferred, it's actually tax-free. The CDA also gets credited when your corporation receives life insurance proceeds above the adjusted cost base of the policy. That's a strategy we'll cover in another video, but the short version is that corporate-owned life insurance and the CDA work together in a way that can convert retained earnings that would otherwise face dividend tax into a completely tax-free transfer to your estate. If your advisor has never mentioned the Capital Dividend Account to you, that tells you something important about how comprehensive your planning actually is. Not all dividends are created equal. Eligible dividends, which are paid from income taxed at the general corporate rate, carry a larger gross-up and dividend tax credit, which means lower personal tax when you actually receive them. Non-eligible dividends come from small business rate income and carry a smaller credit. So in this case, your corporation tracks its capacity to pay eligible dividends through something called GRIP. That stands for General Rate Income Pool. Basically, in this case, paying the wrong type of dividend in the wrong year can cost you money in the long run. Paying the right one can save it. Your advisor and your tax accountant should be coordinating this conversation for you every year. Your corporation can lend money to you, but the rules here are very strict. The loan here needs to be repaid within 1 year of your corporation's tax year end. It needs a formal loan agreement. It needs to charge market rate interest. And if you miss any of that, the full loan amount gets added to your personal income for that year. Used correctly, a shareholder loan is a legitimate cash flow tool. However, if it's used carelessly, it's an expensive mistake that could have been avoided with just a 5-minute conversation. Every one of these tools interacts with the other. The CDA affects your estate plan. Your salary dividend mix affects your RSP room. Your RSP room affects your IPP eligibility. Your IPP affects how much stays in the corporation. This isn't complexity for its own sake. This is what a coordinated financial plan actually looks like for an incorporated professional or business owner like you. If no financial advisor is sitting across from you and walking through this entire picture together, you're not really getting financial planning. You're getting portfolio management. And for someone with your complexity, that should only represent about 10% of the job. I'm Harry Sale, financial advisor at Raymond James in Toronto. I work exclusively with incorporated professionals and business owners and their families across Canada. If you want to understand how all these pieces fit together for your situation, the link to book a call with me is in the description. No pitch, just a real conversation.